Hello, good morning, everyone. Thanks so much for joining us. My name is Monique Charland. I'm the CEO of the National Franchisor Company Business Accounting Network, or better known as BAN. So a warm welcome to all the business owners joining our monthly business webinars for the first time, and a very warm welcome to all our clients. So this morning, we are going to discuss a topic where little or no information is available for the layman, and which is unfortunately seldom explained to business owners by their accountant. So many small business owners do not have the expertise to prepare annual financial statements for their company in terms of the Companies Act or the Closed Corporations Act, and therefore outsource this role to an independent accountant. Or some companies require an independent review in terms of the company regulations. So consequently, certain reports must be included by that independent accountant or the independent reviewer, either with the annual financial statements or as a consequence of attempting to prepare or independently review annual financial statements. But what you might not know is the meaning of these reports of the independent accountant or the accounting officer or the independent reviewer, or even the director's report itself. And more critically, how so very important these reports or letters are for the small and medium business owner to understand, because it can have an impact on your business one way or another. And what has probably never occurred to many in the small and medium business owner sector, and that is the impact that a lack of understanding of these reports or letters have on your business. It can literally teeter on the edge of the very survival or continuance of future operations of your business, or it could mean leaps and bounds ahead for your business. So our presenter today is Russell McLaren. Russell has been a BAN franchise owner for over 6 years, and he's based in West Beach in Cape Town. Russell obtained his Bachelor of Accounting Science degree in May 2011 and completed his CIPA articles in 2001. Russell is a member of CIPA, which is the South African Institute of Professional Accountants, and has been practicing as an accountant for various audit and accounting firms since 2002. So he's packing in 19 years of working experience in this profession. So just before we get started, Russell and I would love to hear from you. So as Shane mentioned earlier, if you do have any questions during the presentation, please type them into the chat box in your control panel on the right-hand side of your screen, and we shall see you after the webinar and tackle those questions you have. Right, so let's get into it. We'll cross over now to our presenter today, Russell McLaren. Hi, Russell.
Hi, Monique. Thanks for that intro. Really appreciate it. Yeah, looking forward to getting into some detail as to all these reports that are very often overlooked by small business owners. So I'm really looking forward to getting them involved in or getting them upskilled in this area so that they can have a better idea of their responsibilities. The accountant's reports to annual financial statements, why are they important, and the impact they can have on your business. All right, we're going to look at a quick introduction. Usually, outsource the small business owners usually outsource the preparation of annual financial statements to an independent accountant. Independent accountants will assist in preparing some of the reports on behalf of the directors and members and compile a report of their own. And then lastly here, many directors and members are unaware of the importance of these various reports and the impact they might have on their business, such as financing. Right. Now let's get into the entities, the different types of entities and the types of reports. Starting with companies, okay, the directors report to the shareholders, right? The director's report is required to be prepared by the directors and included in the annual financial statements of the company as per the Companies Act. So that's a statutory requirement. All annual financial statements for a company must have a director's report. The director's responsibility and approval of the annual financial statements. This report is not required by the Companies Act or its regulations, but it is prepared by the independent accountant for the attention of the director to ensure that they understand what their responsibilities are in terms of the Companies Act. So it details their responsibilities before they sign their annual financial statements. There is also a compilation report. The compilation report is a report to the directors by the independent accountant who prepared the annual financial statements, and this is included in the annual financial statements. The report of the independent reviewer. If the company is required in terms of the Company Acts to have an independent review, this is somewhat similar to an audit, but with limited assurance provided, such a report will be issued. Okay. Then in close corporations, other types of entities that we're going to be dealing with, the other type of entity we're going to be dealing with today, the member's responsibility and approval of the annual financial statements. This report is not required by, also not required by the Close Corporations Act, but is prepared by the independent accountant for the attention of the member or members to ensure that they understand what their responsibilities are in terms of the Close Corporations Act and the responsibility for the financial information contained in the annual financial statements before they go ahead and sign them off. So both in the Companies Act and Close Corporations Act, we provide a report where the directors state that they are aware of these responsibilities. The accounting officer's report. Okay, the accounting officer reports in terms of section 62 of the Close Corporations Act. We will have a look at that a bit later on in the webinar. And then also a report on factual findings. This report reports on the factual findings or results of the procedures carried out as defined in the accounting office engagement letter with the client. We'll also look at that a bit later. Okay, let's move on. Okay, other reports issued by the accountant. Okay, there's the management letter. All right. Okay, this is a report by the independent accountant or independent reviewer to the directors of a company or by the accounting officer to the members of a close corporation. Okay, so it doesn't form, okay, never mind, we'll get back to that in more detail later on. There's a reportable irregularity, which is also another report issued by the accountant. That is, it's a report by the independent reviewer to the CIPC. And then a reportable contravention is a report by the accounting officer to the CIPC. So these are extra reports that don't form part of the annual financial statement, which are then submitted to, when needed, used. Great. Let's get on to the director's report. Who is responsible for the director's report? The director's report is required to be prepared by the directors in the annual financial statements in terms of section 33 of the Companies Act. The independent accountant will prepare the director's report on behalf of the director when they compile the annual financial statements. Just a quick important matter is to understand that, remember, the director's report in everything it contains is the director's responsibility. Even though they appoint an accounting officer to assist them in preparing the report on their behalf. You'll find the reason for this is because many small business owners don't have a knowledge of the Companies Act, so they're going to engage their accountant to assist them in complying with what is needed to be reported on. Okay. The purpose of the director's report. The report by the director to the shareholders is to be presented to the by the directors to the shareholders at a board meeting. So even though you have a situation where you've got one director and one shareholder, you still need a director's report, even though you're only reporting to yourself, because that is what the law says. Okay. That is required to be covered in the director's report. Okay. Now, the Companies Act mentions with respect to the state of affairs of the business and the profit or loss of the company. Okay. The state of affairs of a company in a particular financial year is a broad term, and the directors need to apply their minds to the shareholders of the company and the information that the shareholders are going to require. For example, matters that would come up in the director's report would be matters regarding liquidity, solvency, a change in operations, disposal of major assets, dividends declared, etc., and anything else that would be of benefit to shareholders. Okay. Right, so we're going to go through in detail the director's report as to the different matters that need to be addressed in a director's report. So we're going to go into a bit of detail around some things. The first thing being going concern. Over here, you'll see here, going concern is the ability of a company to pay its debts as they fall due, the fact that assets fairly valued exceed liabilities, and the company makes sustainable profits. Directors are responsible to assess the going concern of a company for the next 12 months after signature of the director's report. So directors need to sit down and actually say, okay, what's going to happen in the next, at least the next year, and how do we need to report on this? What type of matters would impact going concern? All right, these would be markets that the particular company business operates in, its trading conditions, its solvency, its liquidity, its potential loss of key customers, the actual demand for product services, and the trading, and if it is incurring trading and operating losses. All those factors need to be looked at, but obviously that's just an example of a list. That is not everything that you would need to report on any sort of matter that would be a problem for going concern. So you need to, the directors would need to actually sit and apply their minds here. Okay, another matter would be events after reporting date. Okay, these are events arising from the date of the financial year end to the date of the signature of the annual financial statements. An example of this would be if the financial year end is the 28th of February and the financial statements are signed on the 15th of August of the same year, it would be events up to the signature of the annual financial statements. Right. So matters that can materially affect the company. So that's matters that you know about as at when you sign those annual financial statements. So the directors would need to report on matters up to the date of the signature of the annual financial statements. Now, an example of this would be if back in last year in 2020, example of this would be an impact assessment. An example would be an assessment of the impact of COVID-19 restrictions imposed by government on the operations and viability of the company. In this case, the directors would need to assess and comment on the impact of the restrictions imposed. So if they're in a particular business that's going to have a major negative impact on their operations, they would need to definitely report on such a matter, because it is so critical to the presentation and how those financial statements are read. Directors report. Another aspect that needs to be commented on in the director's report is share capital. You must remember that directors are responsible to report on changes to issued and authorized share capital, because the unissued shares are under the control of the directors. Okay, so directors need to inform the shareholders if any new shares have been issued, as this could decrease their percentage shareholding. In other words, dilute their current shareholders' investment in the company. Directors are responsible to have the company valued at a market value before the company can sell unissued shares. So this is a case of so directors, because they control the shares and they're reporting to shareholders, becomes very important to tell the shareholders, look, we haven't issued any of the unauthorized shares to anybody. So we have not diluted your shareholding in the company. So that makes a very important piece of information for shareholders. Obviously, in a small business where it's one director and one shareholder, you still need to make this comment, even though you still need to. I would say you still need to make it, even though the director and shareholder are the same person. Right. Directors' report will also need to comment on the dividends. All right. Directors are responsible for declaring dividends. Remember, seeing that the management of the company's financial affairs are the responsibility of the directors, the decision to declare or not declare dividends is theirs based on future cash flows and investing activities. For example, dividends can be withheld to finance expansion activities. There could be there's always a reason as to why dividends would be declared. It's not you can't arbitrarily declare a dividend. You have to the directors have to take matters into consideration. They could withhold dividend payments to rather use that money to expand operations or for any other type of purpose. Dividends are subject to restrictions. Like I said earlier, you cannot, directors, when it comes to dividends, you cannot simply just declare dividends, all right? Unless the company can remain solvent and liquid. Okay, like we said earlier, liquid means to continue to pay the debts on time. Solvent means assets fairly valued exceed liabilities. And if you're unsure of these two, liquidity and solvency things in your company, you should contact your accountant so that you can actually see if you can declare dividends or not. Very often, believe it or not, I have actually seen dividends and dividends declared and withholding tax paid on dividends that actually exceed the retained earnings and profits in a company, believe it or not. It's not unheard of. It's wrong, but it's not unheard of. And that is exactly why you should always consult your accountant when declaring dividend. It's very, very important because you don't want to jeopardize the functioning of the company. Directors' report solvency and liquidity tests. These are the directors' responsibility at all times. So directors are responsible for maintaining the solvency and liquidity throughout the financial year and need to report on this at year end. Certain transactions are subject to solvency liquidity, such as dividends and loans to related entities. Okay. Directors should be aware that granting loans to related entities, these include loans to directors and shareholders for that matter, if a company is in an insolvent position, can be reckless trading and in contravention of a company's act. This usually happens, all right, where there's loans to related parties like directors and shareholders when there's already a loss, a carried forward loss, an accumulated loss in the annual financial statements. You could be trading in an insolvent position and in contravention of the Companies Act. So that's very important to keep in mind. And this sort of thing, you should always, when you make these loans, you should actually speak to your accountant to say that they are not in contravention. You can actually do it. There's nothing arbitrary about these things. Right. Director's report, disposal of a major asset. What needs to be disclosed? Directors need to report if a major asset was sold during or after year end, as it would have an impact on revenue, profits, and possible dividends paid to shareholders. An example, if a major asset like a company, like a property in a property company was sold, this would result in a loss of rental income, therefore a loss of profit and possible decline in dividends. An interesting thing is that directors would need to actually, in a case like a property company, directors would need to explain the reason for the sale and what happened with the proceeds of the sale and its impact on shareholders. So they'd actually need to report briefly on the sale of that major property in a case like that, just to inform their shareholders, which is their responsibility. Okay, director's responsibility and approval. The purpose of the report. This report deals with a list of directors' responsibility with regard to financial information as well as notes. These responsibilities include to maintain adequate accounting records, that the annual financial statements satisfy the financial reporting standards, proper internal accounting controls of the Companies Act and regulations. This includes measures to help detect fraud, management of risk, and assessment of going concern. Financial reporting standard will either be historical cost basis, which is a evaluation of assets and liabilities at cost, or international financial reporting standards for small and medium entities, which is a fair value based system of financial reporting. Here as well, I'd like to introduce you to the BAN Director's Guide. If you are ever unsure of your responsibilities as a director, BAN does provide a beautiful director's guide to the Companies Act, setting out, and this will set out all your responsibilities. So a lot of what I'm talking about in this webinar is actually covered in this director's guide, and what your responsibilities are should you have a company. I actually have issued these to a few directors who needed to be informed of their responsibilities. Yeah, very good reference guide. Just doing a bit of BAN promoting here. Okay, now we're going to move on to the reports compiled by the independent accountant, the first being the compilation report. This is prepared by the independent accounting professional. Okay, what is a compilation report? Okay, a compilation report is simply drafting or preparing a set of annual financial statements by an independent accountant in accordance with company law, company regulations, tax law, and international professional and financial reporting standards. Usually, if there are no material misstatements or representations, the financial information presented in the financial statements presented or financial reporting standard is appropriate and consistently applied. The accounting policies are appropriate and correctly applied. The accountant will report in terms of ISRS 4410. Okay, what is ISRS 4 means International Standards on Related Services. It is a professional standard all accountants are required to apply, and 4410 is the number attributed to the compilation standards. In other words, drafting or preparing annual financial statements or any other financial information of companies. Okay, what does ISRS 4410 cover? Okay, it covers the ethical relationship between independent accountant and management. Very key to this ethical side is the independence of the independent accountant. So that's very high up on the what would be covered under the ethical relationship, that they are in fact independent. Any material misstatements, that is information in the financial records that is sufficiently incorrect that it may impact the economic decisions of someone relying on the annual financial statements. Misrepresentation is another one. An action or offense giving a false or misleading account of the nature of something, e.g., for example, that would be disclosing a current liability as a non-current liability. And then financial reporting framework, this would be either IFRS for SME, like we said earlier, the fair value based, or historical, which is a cost-based system. If any of these four are detected, it is possible that the independent accountant will withdraw from the engagement. So this ISRS 4410 sets out the basic standards to which the compilation engagement is performed, and there are four key aspects of this engagement that they have to address. Okay, and if those four key things are not, that I've mentioned, are not addressed fully to the satisfaction of the accountant, it is possible that the independent accountant will withdraw from the engagement and not issue a compilation report based on their findings. It is important to remember, though, that ISRS 44 is not an audit or an independent review. If you want to know the more detail on differences between audit and independent reviews, please speak to your accountant if you are unsure. Okay, other type of report would be the independent report of an independent reviewer. Okay, what is an independent review? Okay, it's not an audit. A physical check of transactions doesn't happen, but it does provide limited assurance. Okay, it reports on anything that comes to the attention of the independent reviewer that is materially correct. So what will happen is the independent reviewer won't do any type of physical checks on transactions and substantiating of transactions, but it will make inquiries of management, ask questions based on the financial information it has. The accountant will perform analytical procedures, and if nothing comes to their attention, right, that everything seems okay, that's how they report. So it's a form of limited assurance. And the report, if the company is required in terms of the Company Acts to have an independent review, it's similar to an audit, like I said earlier, with limited assurance. The accountant that compiles or drafts the annual financial statements cannot be the same person or company that does the independent review. So it's very key that, just like that there is actually clear independence from the preparation of the annual financial statements to review of the independent financial statements. Okay, this is in terms of the company's regulations, section 26 and 29. As with an auditor, the independent review must be independent from the compiler in every respect. Material matters detected will be addressed in a management letter to the directors. Okay. Let's have a look at close corporations, members' responsibility and approval. Members' responsibility are similar to directors' responsibilities. What are the responsibilities? So the responsibility of members would be to maintain adequate accounting records, to ensure the integrity of the annual financial statements, to maintain a system of internal control, and always report on and assess going concern. Very, very similar to directors' reports and directors' responsibilities. Okay, close corporations, the report of the accounting officer. An accounting officer's report is issued in terms of section 62. Okay. Right, what are the requirements of section 62? Okay, as in the Close Corporations Act. Okay, so per section 62 requires that the annual financial statements agree with the accounting records. That means the trial balance agrees to the annual financial statements. It means that section 62 requires that they review the appropriateness of the accounting policies report on possible contraventions, report these contraventions to the member, if needed to report these findings to the CIPC. Okay. Another part of the accounting officer report would be a report on factual findings. Okay. This report on the factual findings or results of the procedures carried out as defined in the accounting officer's engagement letter, known as the agreed upon procedures engagement letter, that the applicable the applicable member would have signed before the accounting officer is able to prepare the closed corporation's annual financial statements or any engagement regarding the information. So the procedures, the actual procedures that are going to be performed by the accounting officer will be detailed in the engagement letter before the accounting officer commences with the engagement of preparing the accounting officer engagement. Okay. Okay, how does this differ from the director's report? The main difference is the appropriateness of the accounting policies used. Yeah, that's the main difference between the two. Okay. Right. Now, there are a number of other reports that are issued by accountants, which don't necessarily form part of the annual financial statements, but are still reports issued in the process of issuing annual financial statements. Okay, and that would be the management letter. Okay, who issues the letter and to who? Okay. This is a letter from the accountant to the directors of the company or members of a closed corporation, where it has come to the attention of the accountant that while compiling the annual financial statements or other financial information, that possible business weakness or non-compliance of statute has been potentially identified. Okay, the accountant will explain the observation and what the consequences of the misdemeanor is, and provide recommendations on what needs to be done. Under certain circumstances, the accountant will require the directors or members to either respond to their observations or to correct the misdemeanor by a certain date, as the accountant will either, one, not be able to complete the annual financial statements until such time as the adequate response has been received, two, not be able to complete the annual financial statements until the directors or members have effected the recommendations. Three, will have to qualify the director's report and report the misdemeanor in the annual financial statements, or will have to report an reportable irregularity to the Commissioner of Intellectual Property and Companies in terms of the company regulation section 29 if it is an independent review. Will have to report a reportable contravention of a closed corporation to the Commissioner of Intellectual Property and Companies in terms of section 2 of the Closed Corporations Act. Okay, so what will happen is, if any sort of misdemeanors or statutory non-compliance comes to the independent accountant's attention, they will issue a management management letter asking management and the directors to respond by a certain date to either address the issues or make them aware of it. That's the most important part. Okay. What is the purpose of the management report? Okay. It's not part of the annual financial statements, but it is there to address possible material misstatements in the financial statements, misrepresentations, possible reporting standard matters, and judgments and estimations not provided by the client, statutory non-compliance. It's very, very important letter because the accountant cannot sign off the report in the annual financial statement if material matters that have been identified have not been received an adequate response from management. So a little bit of a kind of a walkthrough. What would happen is the accountant would be engaged to do, for instance, a independent review. They would then conduct their independent review, find certain matters, and depending on the seriousness of those matters that they've uncovered, say, for instance, it was statutory non-compliance, they would actually issue this letter to the directors requesting them, look, please sort this out, make a recommendation, these are the consequences, and the directors would need to respond to them by a certain date. Okay. If for instance, it was serious, sometimes you would need to actually report the matter to the CIPC. Obviously, the management letter applies to both companies and close corporations. Okay, some of the reportable irregularities. We touched on that earlier. The management letter can actually report on reportable irregularities as well. Okay. Okay, this is issued by the independent reviewer to CIPC. What are reportable irregularities? So reportable irregularity is any act or omission by any person responsible for the management of the company which unlawfully has caused material loss to the company, or any creditor, shareholder, investor, etc., is fraudulent or amounts to theft, or the company is trading under insolvent conditions. So what would happen is, usually before a reportable irregularity is reported to the CIPC, it would be identified in the management letter. Management would then be asked to rectify the matter if they can. If not, the independent reviewer has to issue a reportable irregularity to the CIPC. And those three things: unlawfully cause material loss to the company, any creditor, shareholder, investor, fraudulent or amounts to theft, trade under any solvent conditions, that would need to be then reported to the CIPC. Okay, other reports, reportable contravention. This is made by the accounting officer of a close corporation. What is a reportable contravention? Okay, this is where the accounting officer has reason to believe the close corporation is not carrying on a business, is not in operation, or has no intention of resuming operations, in other words, dormant. Changes to the founding statement have not been registered, for example, change of members or financial year end. Liabilities exceed the CC's fairly valued assets, in other words, it's insolvent. The annual financial statements incorrectly indicate that assets fairly valued exceed liabilities. So what would happen is the same sort of thing with the company. You would issue, before you issue the reportable contravention with the CC, you would issue a management letter setting out any sort of contraventions that would be given, or any sort of contraventions that should be addressed, and members' comments. And based on that, you would then either report to CIPC, or their management's response to the management letter would adequately address the matters, and you would not have to respond to issue a letter to the CIPC. Okay. As an overall conclusion, the importance of understanding the directors' and members' responsibilities before signing the annual financial statements. There are far too many directors and members running small companies and close corporations that are actually not aware of their responsibilities. And what we've hoped to address in this webinar, in this training session, is to give directors insight as to what their responsibilities are. The importance of the accountant's management letter to rectify matters, sometimes even before the annual financial statements can be issued by the independent accountant. So the importance of the management letter can be very, it's quite significant, because it can be used by directors and members to rectify any matters, to keep them in line with the Company and Close Corporations Act, to make sure that they are actually operating a company that is within that they're fully statutory compliance. So yeah, a lot of the management letters usually only issued if there is a problem. If there's no problem, then there's no management letter really issued. But this is also it's a very important part of the process of having an accountant look at your and actually engage with an accountant to prepare annual financial statements. Should you receive a management letter, it's very important to address those issues so that the matters can be resolved, and that the directors and members can remain true to their responsibilities and keep the company statutory compliant.
There's just an observation from David Armstrong. If this were followed to the T, most smaller companies would be reported to CIPC as non-compliant and deregistered at worst. This is true. In fact,
that's not a lie. That's not a lie.
Yeah, David, in fact, we were talking about it earlier before we jumped onto the webinar. We feel that, this should be part of education in schools, actually, because many people open companies and they really don't understand their responsibilities, and they do put themselves personally at risk of their losing assets and so on and so forth. And I think people need to understand that when they operate a company, they have other stakeholders in that company, and that would be the creditors of the company, and perhaps other shareholders or other investors in that company. And so, and it's also finance houses, bank overdrafts, financing assets and that kind of thing. So really the Companies Act is written to protect these people from sort of reckless trading by directors. So I think that more education is required. People open up these companies without understanding anything about their responsibilities, and I think more education is required, which is why we are presenting these webinars, and this is what you should be asking your accountant. Hitchin McDebbie, great information, truly appreciated. Oh, that's great. Thank you very much.
Very much.
The next question is Gwyneth Fryer. Are there other reference guides available through BAN? Yes, Gwyneth, we have many reference guides through BAN. I think the first thing is to jump onto our website. We have a host of webinars that we've been doing for the last 3.5, almost 4 years. And you can go to the events page on www.ban.co.za, and there's a host of reference guides available. With regards to the directors' reference guides, we do give that primarily to our clients. So if you are a client of ours, please do ask your accountant franchisee for a director's guide. Nalene de Kerk, is there a guide for close corporation members too? Nalene, we didn't invest in a guide for close corporations simply because close corporations can no longer be formed. And we didn't think it would be that useful. But I think the best guide for you is the members' responsibilities and approval of the financial statements that your outsourced accountant will prepare for you. And you do need to sit with your accountant and just get an explanation from them as to what your responsibilities are. I think that's perhaps your best option there. Anything to add, Russell?
Yeah, it looked, like I said, it is quite scary. I was saying earlier about how if every contravention by a director was put on a court roll, we'd be sitting in court 24/7 for years. I think, So I really think that too many entrepreneurs are not aware of the consequences of their actions as merely by becoming directors of companies.
Agreed, completely. Okay, we have a question from Yolandi van der Schijf. Hi, thank you for the information session. Can we access the recording at a later stage? Yes, Yolandi, as I mentioned earlier, you can certainly access it on our website, which is www.ban.co.za, under events and under complimentary webinars. The recording will take approximately 12 hours to load. Buza Bengu, we're coming from COVID pandemic. How do you then justify reportable irregularities if there's substantive evidence the client is clean, if not for the pandemic? Good question, Buza. I think she's just gone offline now. Do you want to take that one, or would you like me to take that, Russell?
So that's if the can you just repeat that again? A little bit.
Sure. We're coming from COVID pandemic.
Yes.
How do you then justify reportable irregularities if there's substantive evidence the client is clean, if not for the pandemic? In other words, the client would have been okay if it was not for COVID. How do you justify
All right.
reporting to CIPC and a reportable irregularity?
Well, I mean, the thing is, like I said, unless the pandemic itself has put them into an insolvent position, all right, and they continued trading, that would have been a reportable irregularity then. I think you would still need to report that if they did get into an insolvent position. Make no mistakes about that, because that's what the law requires. It doesn't make any qualification as, oh, don't worry, it was a COVID year. That's not what the legislation says. It says if you are insolvent, if the COVID situation made a company insolvent and they carried on trading, then that's a reportable irregularity. You can't not mention that or not report that, in my view.
Yes, I would agree wholeheartedly there. Unfortunately, there are certain disasters that happen to any business. It might not just necessarily be COVID. It could be a fire in a factory, or it could be any other cause or natural cause, or riots or political riots. It does not, unfortunately, deter from the fact that the law requires insolvency to be reported to CIPC. And that is obviously in the case of independent reviews only. Okay. Then we've got Evelyn Deirdricks. Please tell me, what is a confirmatory letter sent from UIF? Okay, that one I'm afraid I'm not quite sure. I don't know if you can take this one, Russell. Have you had experience of receiving any confirmatory letter?
Confirmatory letter from UIF?
Yes. I'm not quite sure what that means, a confirmatory letter. And then she's also asked, is this recording available? My sound keeps dropping. Yes, it is available, Evelyn, as mentioned earlier, on our website, www.ban.co.za, under the events tab. I'm not quite sure, Evelyn, what the confirmatory letter refers to. But other than that, I think that's all the questions. We've got Nalene de Klerk saying thank you. David Armstrong has said thanks. Thank you very much. And
look, it's interesting listening to it here. My main reason for coming on board was to actually see, because I mean, over the years, I mean, I remember seeing a report about 20 years ago from Harvard Business Review. And it's quite substantial in a high percentage, a very small percentage of directors of companies that actually, up to the top corporates, actually, it's about, I think even 10% of them actually base their decisions on what comes out those reports, okay? So that was really interesting because especially we're talking largely about entrepreneurs as well. And entrepreneurs, as you all know, are very different animals. So my point, having said that, coming on here is to try and see where can that add more value with regards to the report to actually change the business. I see your slant is largely towards statutory, and it's quite. But my question would be, you know, it's all good and well saying that the directors don't know what's their liabilities and that are, but especially in trying times like this with tight cash flow, it is almost impossible to get the average entrepreneur to actually comply. And even to, am I making my point?
Yes, I think, David, you're coming across loud and clear, and I think you're speaking on properly behalf of just about every entrepreneur there is, and that is that accountants are very focused on the statutory side of things, but how do you fix things? How do you get better? And I think, are you maybe perhaps approaching the more of the business and the business consulting side of aspect? So it's not just about reporting on insolvency, but how can we turn this company around into a solvent position again? Rather looking at the more positive side of things rather than just the statutory side. Is that what you're referring to?
I am. I do consulting. I'm not a qualified accountant, but I got involved in this over the last 20 years, having been in management and a technical background. And strangely enough, I was drawn to it because the first time I had an accountant to deal with in the financials, I got so frustrated. It was an IT company. I got so frustrated because this guy would come once a month, and I couldn't ask him any penetrating questions. And those days I knew a lot less than I know now. Okay. And he never really added value. So the point is, what I'm saying is value is saying exactly what you're saying. And now, especially with the last year with this COVID thing, I have one client now which has got a severe cash situation to the point that he lost 60% of his business immediately. He deals with airlines and things like that, supplying them. And he lost 60% of his business the day after COVID happened. Okay. The point is, prior to that, it was about a 10 million rand turnover company, and he makes a very good margin. He takes off a substantial amount of money, okay, out of that small company. But now everything is tight, and the point is that this is not the first time to try and get the entrepreneurial animal, okay. Over the years, I've had others as well, to try and get them to change and not realize that it's their entity, that is not their entity, that is not their cash. This very same person now, I drafted last year. I did a balance sheet for him so he could get to get a loan to carry him over. That was fine. The money was going to be used somewhere. It wasn't. He now wants me to do another balance sheet to present to the banks so that he can get money. I have refused, okay, because technically he is insolvent, but sadly he's not insolvent because it's a little business that is ticking over. My point is this. Right from the 96, I've had to deal with this kind of stuff, where I've dealt with successful entrepreneurs. I think of another woman. She was businesswoman run-up of the year a number of years ago, dealing in millions in the mining industry, okay? But couldn't read a balance sheet, an income statement. But there was always a huge amount of money in the bank, what have you. So what concerns me is that, especially now, you made it very clear, Russell, for the first time for me, I realize you've got to tie up with CIPC and with their regulations. But the fact of the matter is that to have to report, all the companies that I've worked with, most all of them, they would be reported now. And they were substantial companies. No, really. So
yes, you are 100%. We see that very much, David. Very much so. So it's not new to us for sure. I think there's two things that come up here. You know, the whole thing is when you are an entrepreneur and you are running a business, there's two things that are important in my mind as an entrepreneur myself. The first thing is forward planning. You never know what tomorrow is going to hold. And that forward planning means tight financial management. Now, tight financial management means having proper projected forecasts over the next 2-3 years of the business. And projections of what kind of profits the business can make, and actually putting that money aside for a rainy day. We all talk about a rainy day. So I think that's the first thing that one needs to really cut down on our personal expenses and build up that cash flow, build up that cash for the rainy day. So that's one thing to touch on. The second thing to also touch on is that, you know, you mentioned, for instance, that you have somebody that's, you know, successful in business but can't read a balance sheet. The thing is that can change very quickly. You know, to run a business as an entrepreneur is one thing. Yes, you need to be innovative. Yes, you need to drive the business. Yes, you're wearing about 9 different caps to run the business. But at the same time, you can't abdicate a responsibility for your business in terms of the financial aspects and say, well, I'm going to go leave it to my accountants. Okay, can't do that. So those entrepreneurs still need to educate themselves, because that's probably the most, there's 2 critical things in a business: financial management and marketing. And you get one of those 2 wrong on that scale, you're going to go one way or another. So
Sure.
I hear you, I hear what you're saying, but there are solutions to it, and I think most of it is an investment in education and skills in this area. What do you think? Any comments on that, David?
I hear you there, but once again, you know, I mean, first and foremost, most people, when you go into business, you know, you have no idea whether it's going to succeed, and then it does succeed. I've never had the privilege of going from a small company to a big company to being listed. I mean, I'm sure if you spoke to Jeremy Ord, he never ever envisaged being as big as it became. Okay, I'm battling to find, because I actually went into the consulting in the last 5 years because I see a desperate need for the smaller guy, because also, I'm sure you'll agree, I hope you'll agree, accounting is not rocket science. It is not difficult to understand. It is awkward to understand because of just the nature of the illogic. I'm just saying it is, and my take is, because I as a non-accountant, I have electronic background, okay? I went out after that episode in '96 with my accountant and also my bookkeeper, because I couldn't quite understand. I knew she wasn't doing the right thing, but I had to figure out how to understand it. My point being that to me, ultimately, you know, I have a way of understanding accounting and explaining it, which makes it very simple for the average person, okay? And but now I've been, and that was my take in the last number of years of trying to actually deal with entrepreneurs with the objective of it going in there, setting up their systems and complying, like you are saying, and then ultimately 1 or 2 of those might someday become a big company, and then by the time they get there, they already have the structure in place. You know, they don't have to then suddenly go to a new application, go to SAP, go to Oracle, what have you. They already have a very substantial GL. They already have systems that actually are expandable. The problem has been dealing with the entrepreneur.
Yes, very much so. It is a change of mindset.
Yes. So I'm at the point of, I mean, that very woman I'm telling you about, I mean, she ended up with an agency, second to none, competing with the biggest companies here in the country, but she no longer has that anymore, because the first couple of years, her branding was awesome and all that kind of stuff. The first couple of years, she really stood out, got all the awards, etc., etc. But I'm sure you'll also agree, it's easy to get up there, but it's not easy to sustain.
Very, very, very true. Sustainability is really the key. And but these are things that accountants and you know, business consultants, which obviously is a service we provide, should, you know, these are the kind of questions business owners should be asking their accountants.
So, Monique, but that is, I guess, why I've been on. I mean, it's one of the first webinars I've managed to actually, because every time I've actually managed to attend of yours, but I've been on your mailing list quite about 2 years now or something, I think. But one of the reasons was about that, and it struck me as potentially offering all the backing that I'm talking about, because especially as a non-accountant, you know, you probably gathered that I have the ability to communicate between the two and with an in-depth understanding, okay? But not being one to sign off and what have you. So, but to find someone, an accounting company like yourselves, that also has the company at heart, you know. So anyway, that is my point is not just to find. Not to have a box ticking, and all this statutory stuff is not making it any easier, because it becomes more important just to comply. And you know, and it's a once a year thing or twice a year thing, you know. So my point is, even when I'm listening to talking to you, Russell and Monique, your conversation you had before, that's the same conversation from 20, 30 years ago. So are we just to accept that the accountants are just there to actually do the books, to comply, and increasingly so, and you know, let what be whatever will be? Or are we going to, or can we add a lot more value, as is always proposed?
So, no. Okay, so David, maybe this is a discussion perhaps off the webinar.
Yes.
But it's certainly the services we provide, because we understand the laws, we understand the regulations, we understand why they are there in the first place. This is where we consult as well with our clients. But maybe this is a discussion to have off the webinar, and you're most welcome to give me a call after the webinar, and the number is listed on our website, and we can have a discussion of the webinar if you like. There's one or two questions. I know we're running 4 minutes over time, so let me just tackle what I can tackle for you. I'll tackle the quick answers first, I think, and then I'll come back to the more complex questions. Evelyn Dietrichs, she agrees with you, by the way, David, works as a consultant bookkeeper. She's asked, must I be registered with a regulatory body? Evelyn, if you are providing bookkeeping services or you're doing anything for SARS, so if you are submitting, say, for instance, VAT returns or employee returns or income tax returns or anything like that, yes, you cannot, and you're obviously charging a fee for it, then yes, you cannot be providing those services unless you are registered with one of the controlling bodies, as well as SARS. But if you're just a consultant on bookkeeping, then no. If you're not involved with SARS, then not. Buza Bengu, I agree substantially. Sustainability is the key for any business now. Yes, I would agree, and David has mentioned that as well. Thank you so much for hosting, as usual, Shane. And this is probably one of our last business webinars this year. And I think that importantly, you know, if you're not sure as an entrepreneur, yes, your skills aren't in these areas. And this is the reason why you should be hiring a really good professional accountant that doesn't only know the statutory requirements, but can also assist you in tough times like COVID and so on. So somebody that can extend their skills far greater than just the compliance side of things. And yes, contact Business Accounting Network. We've got a host of accountants right around the country that can assist you with many issues. So give us a call. Our contact details are below. We would absolutely love to hear from you. So we'll see you shortly in our next business webinar series when they kick off, I would imagine, in February, March next year. Thank you so much, Shane, and thank you, Russell.
Okay, thanks so much, Shane and Monique. I think from the feedback that we got on this webinar, we looks like we struck a chord of a bit of a fear and apprehension about being directed and all the sort of requirements. So yeah, I think the message did get across. But thank you so much, Shane and Monique, for assisting me.
Great pleasure.
You're welcome. Thank you very much, guys. Have a lovely rest of the week.
Okay, cheers, everybody.
Bye-bye.
Thank you. Bye-bye.